Welcome to the A.J Brown Show, where we talk about all things investing, options trading, and the like. Now here's your host, AJ, whose primary mission in life is to help you become a better investor.
All right, everyone. Welcome back to another episode of the A.J Brown Show. My name is Cyprian Francis, and with me, as always, the guy we named the show after, AJ. Good morning.
Good morning, Sip. How are you doing?
Happy summer morning.
That's right.
We're in the midst of this doldrum, July 22nd.
That's right.
Since our last conversation, the rally has continued to go up. And so this morning I was thinking, I wonder what AJ has to say about this bottom, because we did a video a couple weeks ago about did we find a bottom? And I'm curious, what are you seeing on your end?
All right, so let's go right into the technicals on the chart. So we've been following, as you know, some of these retracements, and I like to use retracements to get an idea of what's coming next. If the retracement is around halfway the previous move, then that's going to be more of what we call a range contraction move, and you can reverse engineer it into what direction the trend is. If it's about 100%, then that means that we're in a sideways kind of movement. And what we're seeing right now, if we look at just the last, say, 5 days, let me go ahead and draw. This is the previous retracement right here. And then if I put my ruler stick on there, we'll go ahead and measure from the top of the retracement down to the bottom of the retracement. You can see here we've already kind of bumped ourselves out of the sideways move to hint at a range expansion move in the up direction. Now, if I zoom out even further I'm looking at a 3-month chart, but I'm going to look at a 6-month chart. We do have a lot of distance to go before we actually call this an uptrend. This is the first move, but we don't really call it an uptrend until we've got 2 tests of ascending support and 2 tests of ascending resistance. So the question is can we maintain this, especially with what's going on next week, which of course is another one of our Fed meetings.
Yeah, and so that's kind of what a lot of investors are waiting for. But this week, we're getting pounded with earnings, right? And so earnings are affecting the market, and we'll go into earnings a little bit later in the show because there's a couple names there. But in terms of the Fed, right?
Yep.
That's going to be the meeting next week, and the big talk is 75 or 100 basis points.
That's right.
But you always like to touch on the bond buying. Do we have any updates on that?
Well, okay, so a couple things. Well, let's go right to the bond buying, but then I have some other news from our economic calendar, because once a month, and I'm going to kind of wet your palate here, Sip, and everybody who's watching, once a month we get a report about foreign investment into the U.S. economy, right? And they do it the same way that the Fed does, and they do it by buying bonds, right? And so let me talk on that in a couple moments. That was my palate wetter, but let's jump right into what the Federal Reserve has been doing. So we knew that they had sold off a bunch of their bonds, and when the Fed sells off bonds, the money they receive by selling those bonds gets shredded. It gets dissolved. In other words, they're pulling money out of the markets, out of the investment markets, out of the economy ultimately. And this past week, we saw a little bit, just a tiny bit of buying. So maybe they said, hey, the prior 3 weeks or 2 weeks of selling, maybe we have to moderate. Now, of course, after this show is over, we'll get the next leg, last week's bond buying or selling added to this chart. So we'll see if they resume the selling, but it looks like they moderated for a week. And one of the things, I'm going to turn back now to that whole international thing. One of the things I picked up on was that one of the biggest economies in the world has been also selling bonds. And of course, that's China. Now, I have this pictorial that a friend of mine posted on Facebook. Thank you, Larry. And what this shows is for 2022, despite all of the talk of global inflation and downturns across the world, 2022 is going to be the first year that if you add up all the GDPs around the world, that it is greater than $100 trillion. And this is a really nice picture that my friend posted. And it shows the United States is going to have an economy coming in about 25.3 trillion. China's behind us at 19.9 trillion. You can see some other names like India, 3.3 trillion, Japan, 4.9 trillion, Germany, 4.3 trillion, the UK, 3.4 trillion, Russia, 1.8 trillion, and some of the other economies out there. But the big players, of course, are the United States and China. And you can see here a little footnote. China's GDP is projected to surpass that of the US in 2030. And this little footnote over here, the US has been the world's largest economy since 1871. So if you think about that, 1871, about what is that, 130, no, 140, 100 and, well, I'm not even counting right, 160 to 170 years later, it might be that the United States is no longer the number one player in the world, right? And so China is getting bigger and bigger and bigger every year. And it's China that has been pulling out of the US economy. Now, if you back up to when we were doing the show in January and you looked at the different countries that owned US savings bonds and US Treasury bonds, you would see that Japan and China were neck and neck as the biggest owners of US debt. They buy our bonds in order to put their currency more in stable, because the US has traditionally been the stable place to put your excess dollars, right? So Japan has always, since the 1980s, had a ton of money invested in US debt. And China, since about the mid 2000s, 2005, 6, 7, started to pump money till they, were equal, if not surpassing Japan, and each one of them owns about 1.5 trillion. And we've been talking about the Fed writing off about 9 trillion. So if you think about it, Japan and China combined, that's a big chunk, right? And what we found out this month is that since about February and March, I don't know if it's coincidence that it has to do with the invasion of the Ukraine and more importantly, the US's response, or the US and the Western world's response of putting sanctions on Russia and, making it so that they couldn't do their trading on the SWIFT exchange and all of that good stuff. China has pulled out $500 billion from US debt. So some of the theories are that China is, investing in themselves, kind of like a company does a stock buyback to increase their value in the overall market. Well, China may be taking that money out of US debt and now investing it in the yuan, which is now more stable than ever. Or it could be that China has some issues and they need some of that money to bail themselves out. We've been hearing about China having some real estate issues in their domestic economy and things like that. Some bubbles have been bursting over there. And also maybe the pandemic, they've been a little bit more militant about controlling the pandemic, which has been affecting GDP. So maybe my theory is that it's just all too canny that the money has been coming out since about the time of the Russian invasion and the US and Western world response. I think it's more political, in that China is a little bit unhappy with the response of the Western world to how they quickly cut Russia off from being able to do anything in the world. And as you know, China has had its eyes perhaps on reacquiring Taiwan and things like that. And they've been going back on the deal that they had with when Hong Kong became back part of China. The deal was that they wouldn't touch the Hong Kong economy for 50 years. It's only been like 10 something years, and they're already kind of messing with the Hong Kong infrastructure. So there's a lot of eyes on what China is going to do next. And China's probably saying to themselves, listen, I'm going to make sure that I tell the world economically versus militaristically what I think about how it's treating other companies, how it's countries, how it's ganging up on it. So my idea is the reason why a third of their holdings came out of the US in the last 6 months has a lot to do with kind of a a political statement.
So, I mean, this is an amazing chart. Like that stat of the U.S. being the leading economy in the world since 1871 is wild to me. And then I think about the China, how they're going to surpass us, and I try and ask myself why. And I think the answer is because they have way more people. Like they have 3 times as many human beings as us. Therefore, they can be 3 times as productive. So that's just an interesting fact. The question that I have for you on this topic is how does this info relate to the previous chart specifically, or does it not?
It does. So if you think about it, right? If China sells about $500 billion worth of their bonds in 6 months, that is going to affect our currency. It's basically helping us with our inflation issue, right? Whenever there's bond selling by a big player, that's why the Fed uses that tactic. That's why we look so closely at the Fed balance sheet, because when the Fed does selling, that actually tamps down inflation. It removes liquidity from the market. What China's doing is they're removing liquidity from the market, in effect, by selling our bonds out to the market. And so the question is does the Fed have to have as big a response next week, given that we're getting kind of this help from China? China may think that they are, one theory is they may think that they're kind of teaching the U.S. a lesson, but could it be that they're actually helping us control inflation and making the Fed off the hook, right? Because what they're doing is kind of propping down the valuation of the U.S. Currency by doing what they're doing. Yeah, it's an interesting overall global picture, and it can affect our market. So how will the Fed respond next week to that? Or will they not even include it? But I think that they'll have to. $500 billion of bond selling by a big player affects the whole U.S. economy.
All right. So my question to you next week, what are your thoughts on what the Fed's going to do? 75 or 100?
I hate to speculate because the truth is I'm going to trade it no matter what happens. But the scoop is I think that they're going to take it easier than they did last time with this news about the China. I think we're going for 3/4 points, 75 basis points. But we will see. And if I'm wrong, that's fine. I'll trade it with a point. If I'm right with 3/4 point, I'll trade it anyway. So it doesn't matter what I'm guessing.
Yeah, I'm with you on that one. I feel like they could scare a lot of people away with the full point. And the data this week, the economic data this week hasn't been bad. Like we haven't had anything too surprising, and the markets are rallying. So if the Fed comes out and says, "Hey, we're going to just do what we did last time. Everything's starting to cool down. We're getting better." Like that could be good news all around.
And just as a quick follow-on to our discussions last week, Sip, existing home sales came in down, housing market index down, except prices are staying the same. Now, there are some overbought markets, and those are usually the markets on the coast. So the whole coast of Florida, California, Portland, Seattle, not Portland, Oregon, and Washington State, that whole coast, and some of the coastal properties like where I've got my home in South Carolina, those were very overinflated. And so some of those prices might moderate by about as much as 10-15%. But for the overall U.S., it doesn't look like, even though supply is starting to shrink and demand is shrinking, it doesn't look like home prices are going to shrink, because there is that supply to demand ratio, and there's always going to, the supply would need to come up quite aggressively for home prices to come down, and that's not happening.
Yeah, interesting. So we'll definitely keep an eye on the Fed numbers next week. I think let me just see.
It should be in about 5 days. I think it's going to be Tuesday and Wednesday that they're meeting. So Wednesday would be their announcement.
Yeah, so I'm just trying to see if there's anything else, and it looks like the PCE next week too might have some impact. But that Fed rate is definitely gonna be the market driver. And as we mentioned at the beginning of the show, this week's market driver is earnings. And so what we'll do here in a moment is go through some of the names. If anyone watching, listening has a ticker symbol that they want to go through, feel free to drop it into the chat and we'll see if we can discuss it on the show. As we mentioned, here at Trading Trainer, AJ is educating traders, investors of all different levels. He's got a slew of different programs to get involved in. And so we want to invite everyone to AJ's daily workshop where he breaks down a lot of these strategies. And so what we're going to do is throw a link in the chat. Anyone can go in there, sign up if you want to watch the workshop today, tomorrow. You can schedule all that. We'll play a little intro to that, and then we'll go through some of the ticker symbols that are in the news and see if we can find some options trades. So stay tuned, everyone.
I get it. You're afraid of trading in the markets. Guess what? I've got your answer. I've got 4 strategies I'm going to give you along with the tools to make it super easy. I'm going right home, giving you the webinar. I need you to sign up below and meet me in a few minutes.
All right. So head on over, jump in that workshop, and we'll unveil some secrets for you. With that being said, the big news driver of the day of this morning is the social media platform Snapchat. They were down 36% at one point, and it's kind of bringing down all the other socials. So maybe that's something we can touch on is what's happening with these social media companies.
Well, okay, so Snapchat, if you remember, was one that we had done some featuring on back in the day, and we had been looking at it recently. It had really gotten knocked down around the May 20th options expiration day, and then it was in this sideways pattern. And so here's a little trick, and I think I've shared this trick before, but I'm going to zoom in here on my chart. So one of the tricks we like to do to understand what kind of sideways channel it is we like to take the support and resistance lines that we determined. So here we had defined support at about $12.50 and resistance at $15. And we like to know what is the width of that channel. So $15 minus $12.50 tells us that the width of that channel is about $2.50. So it's been oscillating between about $2.50 up and down. And then we like to take the halfway mark. And so you can either take the average of these two numbers. So that would be about $13.75. Or if you're, being able to do math in your head is a challenge, and it depends on the time of the day for me. If you throw your Fibonacci price retracement lines drawing tool on your chart, the 50% line is that average line. So it's an easy way to get a visual representation. So if you take that halfway mark, $13.75, and you do a little bit of division, right? $2.50 into $13.70. Let's go ahead and pull up our calculator and do that. You're going to get a ratio of width to average price. And I'm going to give you some numbers here that help you analyze that channel. So first we'll do $2.50 divided by $13.75, and we get about an 18% channel. Now, if we got a number below 5%, the possibility that that is going to break out, meaning it's going to not stay going sideways at that number, but instead pop up or pop down. Usually it's very hard to tell which one it's going to do, but we know it's just not going to stay sideways, is almost incredibly, it's there. It's not just possible, it's probable. It's going to happen. In fact, if it's below 10%, I have the heebie-jeebies inside of me that that's going to happen. And if it goes actually wide, if it's like above 40%, well, then I think it's in a diverging channel. This one's at 18%, but still we're in this tight range. And so I was completely believing that something could happen. And usually there's a trigger, like it'll stay in that tight range and it will build up pressure, kind of like a pressure cooker. And that's because investors are getting antsy. They don't know what's about to happen. And so the more pressure that builds up, in other words, the longer that a symbol stays at a single price, it's kind of like I can throw a tinder into that, lighter fluid soaked pile of rags, and it'll pop, right? And so I was expecting it. And what was the tinder? Of course, it was earnings, and it was the announcement around earnings. And so this was not totally unexpected that it dropped like this. The question is will it stay like that? Because it didn't drop that far. So we wonder, is this just a transient knee-jerk reaction, or is this something that's going to be lasting throughout the life of Snap? We'll know by Monday of next week.
Well, expand the time frame, because we're only looking at the 3-month story here. I think what I was seeing was the annual story that is they might be in trouble as a business, because I think the only good news out of their earnings was that their users went up. Some of these social media companies just don't know how to make money.
Well, and that's true, right? Isn't that so? That comes back to our discussion around how the Fed was pumping money into the markets. By pumping money into the markets and making it so that bonds were no longer interesting, all of a sudden the needle moved and people were starting to use actual stocks as their stable investment. And they were now moving their risky investment from stocks into things that were more risky, like new startups like Peloton. Oh my God, how can Peloton make money for the long term, especially when now people are starting to get out again and they don't want to be stuck in their house riding a bicycle? So Peloton was one of those companies. Any of the tech companies, that's why we've seen the NASDAQ drop the way it is. And this reminds me so much of living through the dot-com bust sip, where we had all these dot-coms that had no profit, no cash flow. And as soon as, it came time to get your beans counted by the bean counters, all these companies that couldn't justify their existence went away. I think every 20 years we have kind of this filtering out process of stupid companies. And so Snapchat might be one of those companies where, the bigger companies who established themselves and did a lot of mergers and acquisitions will maintain. And these companies that were still trying to figure out how to make themselves profit. I mean, look at the whole drama over Twitter, right?
Well, that's what I was going to lead into next. But more so, as an advertiser, right? Being in these platforms and using these technologies, Snapchat could be there, but there's like better options, like Meta, Facebook is just killing it in terms of the usability and that they actually are profitable. And so I guess part of the hope is that Snap could get there someday. But then we look at Twitter, and Twitter's been around almost as long as Facebook, and they still don't have their act together. Like their report today was a $270 million loss. Like, what are you guys still trying to figure out?
Right. Microblogging, right? I actually think they increased. They used to be that you had to do your tweets in 40 characters or less or something like that, or 110 characters or less. And I think now they let you do bigger posts. But what is the draw to microblogging? I think that's still a question out there. But yeah. However, despite their earnings report, they're not getting knocked the way that Snapchat did. So I think there's a little bit more in the resiliency, or maybe the purpose behind the company that investors are giving to it. Or maybe it has to do with the investors of Twitter are still in the wait and see phase around the court case now that's going to happen with Elon Musk. I don't know the answer to that, but the investors are being nicer to Twitter than they were to Snapchat.
And on this chart, are you seeing a bit of like, are we creating a little channel there?
It could be. It could be. And I'm seeing that Twitter is topping here. And so one of the things that I'm thinking about, you're right, I see around $32.50 perhaps, a layer of support that's forming. But I'm also seeing, like you pointed out here, around $39.75. We could be topping. In fact, let me pull up my fast MACD, which is one of my favorite indicator sets for determining if a top or bottom is being found.
Well, also part of the bid was, I believe, $42. So I think that's why there's a little bit of a premium there for a while. And once the deal started to deteriorate, it seems like that new channel is more of its actual valuation.
Right. And so here's my knee-jerk reaction. I mean, we haven't gotten a signal from our favorite indicator yet to call that a top. But once we get that signal, I would investigate possibly setting up a short position on Twitter. And you could do that short position by either shorting the stock, or you could actually go ahead and buy some back month deep in the money put options. That's the same kind of effect of doing a short position on the underlying symbol. And so I would do that, assuming that Twitter is going to go down. And then, of course, if Twitter pauses going down, that would be a great opportunity to sell premium and put a protective option in place.
And I'm curious what the liquidity looks like for the options. I'm
assuming let's take a look.
I'm assuming it's pretty solid.
Yeah, it's very solid. Near-term options. I mean, the near-term options. Interesting how options have become more and more not standard, because more and more exchanges are allowing you to trade them, and more exchanges getting involved. They're offering different strike prices. So traditionally, when a stock was above $30, the option chain would be every $2.50. And so you're kind of seeing that, but then you're also seeing these other ones. And the $2.50 ones have this incredible amount of liquidity, whereas the 50-cent ones don't. Let's take a look a little farther out in time, because if you're going to be doing some protective options, our rule of thumb is to buy them 3 to 6 months out. So let's look at the November time frame. A little less liquidity there. Let's look at the December time frame. Okay, so here you can see that we're trading every dollar, and on both the put and the call side, we've got hundreds, if not thousands, of contracts of open interest. So just like you said, I think that there is enough of a playing field out there, even for the biggest investors that want to do large purchases of contracts or large selling of contracts.
Yeah, so we covered Snap, we covered Twitter. Maybe let's run through the big dog of the family in Meta.
Yeah, so Meta is the new name for Facebook. Let me make sure my fingers don't betray me about how fat they are. Over here, we have earnings coming up. So it's going to be interesting to see how Meta responds to its earnings now that Twitter and Facebook, let's see, earnings are going to be on July 27th. So that's next week, after market close. So the earnings conference on July 27th.
On Wednesday, on Fed Day. Wow.
Yeah. So the Fed's going to be making their announcement. The Fed makes their announcement around 2 p.m. So the market stays open for 2 hours after the Fed makes their announcement. But then when the market closes, Meta will make their announcement. And Meta has become quite the part of the economy. I mean, they're a very large company. So that would have some effect. So I'm interested to see if they're going to follow what's happened with Snap or Meta with Twitter, or if they instead go up. But again, they're in this consolidation kind of, investors are waiting to see. So it's all about earnings this week and next week.
Another name that we've looked at as a potential opportunity is Pinterest. And from our discussions, I always thought that they might have the most potential out of the social networks. And I always thought that their price point was really nice for trading options as well.
I gotta say, so if you think about the monetization of social media companies and you think about who the customers are, right? If you think about Pinterest, I always thought that they would have the best monetization possibilities. And that's because people who go to Pinterest are making dream boards, right? They're collecting things that they see on the internet and putting them in one place of things usually that they'd like to get in the future. And so if you've got that person who's thinking about the future and you look at that, as most people know, your data is not private. The minute you start using these free social media sites like Meta, Facebook, Instagram, and all that good stuff, or Pinterest, they're looking at what you're posting and then they're finding things that are similar using their technology, their algorithms, looking for things that's similar to flash up in front of you as far as advertisements. So I always thought that Pinterest would be a good company to advertise on, because if you flash somebody ads that have something to do with what's on their dream board, they'd probably be more likely to be buyers than, say, for instance, a Twitter, which is more in the present, or a Facebook is more of what you're thinking about in the present, not what you're thinking about in the future. With that said, in reality, Pinterest doesn't seem to be able to do much more than kind of keep things, just keep the lights on. They've been moving sideways, and like you pointed out with Snap, if I zoom out a little bit, they have had some downtimes since last year, even before the market started to go down at the end of November, beginning of December. Pinterest has been seeing some downturns, but I've been excited about Pinterest over the last 3 months, the summer doldrums, just because they stalled and they built themselves some support at 17, some resistance at 21, and that makes it good for us selling premium. But yeah, the long-term prospects, and again, they're reporting earnings on August 1st. And so it's going to be interesting now that, things are tightening and people are going back and taking their money out of these more risky investments and putting them into more solid investments. They'll be interested to see what happens to Pinterest. If you're in a premium trade on Pinterest, man, I would make sure you've got your trade zone in place. Or one of the things we always say about approaching earnings is, if you're really in doubt, cash out and then wait for earnings to go by. Don't weather the storm.
Yeah, it looks like that $17 level is a very, very critical support level. My question on, like, I'm looking at this chart action here, and I know that sometimes we talk about the different ways to make money using options. So my question is, if me as a trader am looking at this chart and I think it's going to stay in this range, what strategy would I use to take advantage of that, right? Because there's strategies to take advantage of stocks that don't really do much, stocks that go up, stocks that go down. What does that approach look like?
Sure. So this is where we would want to set up some sort of trade zone, some sort of horizontal band. And we can do that if we wanted to do that more as an investment. We can do that on either a shorted or a long stock. Once we've got that shorted or long stock in place, or a back month option in place as our covering position, we can then set up a trade zone by buying a protective option and selling some premium. That creates this band, a trade zone, where so long as you stay in it, you get income. And if you pop out of the top or the bottom, there's some adjustments that can be made to profit out of that as well. The more traditional strategy, SIP, would be to do something like two vertical spreads, otherwise known as a Condor, or even a variant of that called the Iron Condor. But I'm always worried about using those type of strategies. I would prefer to leg in to my kind of strategies, because that allows me to take advantage of those micro movements of the underlying symbol, which can change the economics of those positions well. So that's kind of the thought process behind it.
So what you're saying is essentially the Iron Condor and your approach are the same. The Iron Condor is just more specific, while yours is kind of this variable where you can make a little bit along the way, but in general, you still have this same. You're still thinking the same thing's going to happen. Just it's elongated a little bit, maybe.
How about we use the word it's more forgiving? Like the
Okay.
Iron Condor, if it does decide to pop out of either side, the Iron Condor can automatically go down, or the Condor can automatically go down to 0, right? You can lose if your hypothesis is not correct that it's going sideways, that investment goes from something to nothing very quickly. Whereas ours, because we've legged into it, we've built profit into it, we can do some adjustments quite nicely and turn it into a winner, no matter whether it stays sideways or goes up or down. We just have to do a couple of quick adjustments. It's not as easy to adjust the Condor. The Condor, it's the strategy that you set up, and if it doesn't work, it doesn't work.
Yeah, and I think that's what people get scared about when they hear options and they start to learn about it, is that there are a lot of ways to approach it. But what you've done over, your almost 2 decades of doing this is figure out a good approach, a strategy that can work over time. And a lot of the members over at Trading Trainer are utilizing it week to week. And so
Absolutely.
once again, if anybody's interested in really getting a deep dive in those and seeing step by step how to implement them, head on over to that workshop that we have. I just pasted the link in the chat. If you have any questions on that specifically, reach out to the team. I know everyone is making themselves readily available to answer any questions. All right, AJ, with that being said, summer doldrums, anything else we should be keeping an eye on heading into the weekend early next week?
I mean, there's nothing specifically besides, taking advantage of whatever profits you can get. But I urge people to, a lot of times people come into the markets and they want to do a quick trade and get that money back out. Do a quick trade, get that money back out. And in the long run, that's a lot of effort in order to just make a few points on your portfolio. What I urge people to do is take the mentality of a mutual fund manager or a hedge fund manager, where they've got a certain amount of money that they need to grow, like their investment account that they need to grow. And if you change your mindset to being a portfolio manager, where your goal is to get your whole portfolio invested in profiting or winning positions, then it becomes a different game than, say, putting a $5,000 trade on and hoping you make some money back, because that actually doesn't wind up working well in the long term.
So the moral of the story is diversify. If you have a portfolio that you that's just sitting there, AJ strategies can certainly help. I've seen that firsthand. We've discussed them over 40 episodes of the show.
Is it 40?
Yeah, episode number 40.
That's today?
That's today.
Oh, we should celebrate.
Well, 40 is 50 is more of a
50.
celebratory.
Okay, I'll see you in 10 episodes. 10
We'll get
episodes.
some balloons and some confetti. Hey, a little
champagne. I'm gonna get one of those helium balloons that says 50 and then pop the champagne for our show. Although helium has become quite the difficult element to get a hold of these days, isn't it?
Yeah, that's a new one for me. Isn't it?
Oh,
what's the demand for helium?
Well, helium leaves our atmosphere. And so all the helium we've used up to date, like there's been all of a sudden, if you pop one of those balloons, the helium goes out of our atmosphere, and it's not, there's a helium crunch. Oh, I've been reading about it. There's a helium crunch. It's a big problem. They're having to ration the stuff.
Well, I'm definitely gonna go ahead and add that to my read list for the weekend.
Or it might be that too many people are inhaling it. You know how that makes your voice high?
yeah, that's kind of why I was wondering what's the demand. Why is there an increase in comedians or clowns these days?
I don't know the answer to that, but yeah.
All right. So with that, everyone, we'll go ahead and call it a show. Appreciate everybody tuning in. If you've enjoyed the broadcast, feel free to hit that like. Feel free to hit that subscribe, that follow button. We appreciate it. If you have any questions along the way, drop them in the chat, hit us in the DM, and we'll get to it as soon as we can. All right, folks. Appreciate the time. AJ, appreciate your time. We'll go ahead and sign off and see everybody next week.
All right.
Thank you for tuning into the A.J. Brown Show. If you're interested in learning more about AJ and his investing techniques, head on over to tradingtrainer.com and create your free account today. And if you're not already a subscriber to the show, hit that subscribe button and we'll get you fresh content daily.